The way Americans are planning for retirement is drastically changing. Corporate pensions that used to be common are now far and few between. And even the long-term viability of Social Security is being questioned. And the fact is, today's retirees are often in charge of managing their own retirement funds. I've asked Tony Moreno back to share his advice on how seniors can invest in today's low-interest environment and volatile markets. Tony, welcome back.
Thank you.
All right, so let's go ahead and get started. If we can you give me a short summary of exactly what today's market looks like?
Well, right now the markets are much more volatile than they used to be. I mean, if you invested in the 80s and 90s, it was kind of easy to invest. Today, you have a couple of challenges, one of them being, especially for retirees, low interest rate environment that we're in.
Okay, and so for those interest rates, are they expected to rise in the future? I mean, we often hear that they're low, but are they going to be going up?
Well, my crystal ball broke some time ago, but I will say this. I mean, this has been on the minds of many. Everyone, if you hear the talking heads and any financial news network, you always hear, oh, interest rates are going to rise, and it has to rise because Fed policy is driving interest rates down artificially, printing money. I mean, all that.
Yeah.
The real issue is if there's no demand, it's going to be very difficult for interest rates to rise, because we've had pretty much a recovery that hasn't been, it's been kind of slow. So even though interest rates went up a little bit in 2013, they fell again in 2014, and we're watching it. But the idea is that they will eventually go up, but they can also stay at this level for some time.
Okay, well, let's jump right into this. What should be my primary goals after retirement? They obviously change based on where you are in your life.
Well, obviously, when you're in the accumulation phase, you're going to want to invest in something that's more growth oriented.
Right.
As you get closer to retirement, you want to shift to something more conservative. Now, the key there, especially the challenge for retirees, is when you're in a low interest rate environment where you're only maybe earning, I mean, in the savings account, you're not earning
right.
much, but even in bonds, you're maybe earning 2-3% as you take more risk. So really, it's how much money do you have, how much income do you need, what's the timing of that, and then structuring a portfolio that's going to provide that income. And you have to be a little more dynamic and look at alternative investments nowadays because interest rates are so low.
Okay, so let's talk about some of those alternative investments, because I know some folks have often thought that bonds are kind of the safest way to go.
Well, bonds can be safe, but it's kind of difficult, especially, again, when bonds are paying 2-3%. And obviously, to get any higher yield in bonds, you have to take higher risk.
Yeah.
And at retirement, you don't want to take too much risk. But here's the challenge, and this is a law. It's not a theory, but as interest rates, if and when they do start going up, and you own a significant amount of bonds, those prices will fall. So that will affect your overall portfolio, your income that you're receiving. So you have to be really careful. We recommend typically going much shorter maturities, especially because, if interest rates do go up. The other thing you can do is look at alternative investments, other vehicles that can provide a higher yield and higher income down the road.
What about annuities? Let's touch on those real quick.
Annuities could be tricky. Annuities are sold many times by insurance professionals, investment advisors. The challenge there is you really need to look at the fine print. Many annuities provide some guarantees, some safety nets, an income guarantee, but you have to really look at the structure of the annuity. You have to be careful depending on your liquidity needs, because there is a lockup period or surrender period. The fees are typically high, but again, appropriate for certain individuals depending on their needs from an income perspective as well as from a planning.
Okay. Now, I'm about 25 years away from retirement.
Mm-hmm.
Is it true that if you diversify and you just kind of diversify and just kind of stay, that you're going to be okay?
That's been the common belief. Unfortunately, that also could be dangerous because diversification, remember, is a risk management tool. And the idea is you own a little bit of everything, so God forbid something happens negative to one area of the market or a company, it's not going to decimate your portfolio. However, if you look at 2008 or any business cycle, diversification fails you. So a lot of times you have to be a little more dynamic, and look at other risk management tools. It's very difficult to time the market. In fact, you don't want to time the market. But most people have a finite period of time to invest. And if you look at from 1966 to 1982, the market went nowhere. Look at 2000, 2010, market went nowhere. So what do you do? And that's why you need to meet with your investment professional and really come up with a strategy that's going to fit for you.
Well, a lot of information to absorb. Where could people go for some more information or to stay current? What do you recommend?
I would say, going to those financial news networks, there's a lot of information there, but that's the problem. It's like drinking out of a fire hose. So I don't recommend, that's good for information, but I do recommend that you speak to an advisor. There's a lot of great books and websites you can go to nowadays, but usually sit down with an investment professional that can help you.
All right, Tony Moreno, thank you very much. Great information. If you don't have an investment advisor, listen to Tony. You should get one. Thank you very much.